So, can you still raise JV finance in order to invest in property when interest rates for savers are high, relatively high at the moment compared to recent years, but also, whilst at the same time, interest rates for borrowers are high, okay? So mortgage interest rates are pretty high these days. So that actually is presenting a bit of an issue for a lot of people wanting to raise joint venture finance, using other people's money to invest in property, literally giving them a better rate of return than they're getting in the bank. So my take on this is yes and no. And so buy-to-let, I do buy-to-let, I do HMO, and I do serviced accommodation. Now, I scale currently my serviced accommodation business, my serviced accommodation properties, my buy-to-let and HMO, not so much. In fact, I turn buy-to-lets and HMOs into serviced accommodation when I get them back from tenants. Why? Because I'm able to earn more money from the same property doing serviced accommodation over buy-to-let and HMO. So therefore, serviced accommodation represents a better rate of return for an investor, because guess what? I am an investor. And so when it comes to raising joint venture finance, is it going to be easier doing serviced accommodation, i.e. using their money, investing it in serviced accommodation? So in my experience, yes. And I'll explain why. Let's say, call it buy-to-let. So most people understand buy-to-let property investing, don't they? And so you've got a house or an apartment and you are letting that out to tenants as buy-to-let. Here's the problem with that. With mortgage interest rates high and property prices high as well, then the return on investment ends up pretty low. I mean, let's say you needed £50,000 in order to do a buy-to-let property, and that just represents the deposit and some fees, etc., etc. You know, in more expensive parts of the country, that wouldn't come anywhere close. But let's say it's a relatively cheap area in the country and you need 50k. So to borrow that 50k from a joint venture partner or an investor, you're going to have to obviously compete with bank saving rates, interest rates for savers. Well, it's just not stacking right now. You know, I know people doing buy-to-let at the moment and they're literally not making any money from it at all when they're paying higher interest rates, because, you know, the rent coming in is hardly covering the mortgage. So that doesn't really stack, in my opinion. Borrowing money in order to invest in buy-to-let, obviously it still can be done, but many investors are wanting better returns than they're able to get from buy-to-let. And then there's HMO. Yes, you can earn more money from an HMO property, but I think buy-to-let and HMO, the pendulum has swung too far in the direction of the tenants in terms of who has actually got control on the property. And so me personally, that it's worrying me, especially with this renters reform bill coming in, the fact that I'm not going to be in control of the property, and therefore you're not really in control of your investors' money either. And again, with HMOs, the energy prices have gone up significantly. I know they've come back down a bit, but they're a lot higher. Then you've got the interest rates. You've got Section 24, which means that you can't offset your interest against the rent. And so again, HMO for me isn't doing it. And this is exactly why I turn HMOs and buy-to-lets into serviced accommodation, because literally my strapline is more money, less tax and no tenants. So let's look at serviced accommodation then. Well, a well-run serviced accommodation property should cash flow in the region of £1,000 per calendar month. Now, sometimes they cash flow less for me. You know, I think about a 1-bed flat or a studio apartment or something like that. That's not competing with multiple hotel rooms, and so therefore sometimes the cash flow can be less than £1,000. You know, it might be £500, but definitely nothing below £500 cash flow. But I've got some other properties, some larger houses that are literally cash flowing £2,000-3,000 per calendar month. Now, when I say cash flow, that is profit. That's, well, pre-tax profit. That is after all of the bills in the property are paid, you know, utilities, OTA fees, Booking.com fees, you know, cleaning fees, laundry fees, all of those costs are deducted. That's the profit. So let's just use a benchmark of £1,000 in terms of profit. You could represent a significant return on investment to an investor if they were to give you the money to do that serviced accommodation property. Let's say it's just a rent to serviced accommodation property, and let's say you need £5,000 in order to do it. It could be more, it could be less. Remember, with serviced accommodation, you know, you've got potentially a deposit, you've got potentially the first month's rent, and potentially you need to furnish the property. Well, we've had properties, and I know people that I've taught service accommodation to that have rented property without paying a deposit. So that's doable. Definitely, if you go direct to landlord, excuse me, if you go direct to landlord, not via a letting agent, you can negotiate doing it without necessarily paying a deposit. And also you can hire the furniture. So you can lease the furniture. And the way we set it up is after 3 years, you literally own the furniture as well. And all of the lease costs are tax deductible expenses. And so therefore, you know, you could do a rent to SA for less than £5,000. But let's say it was £5,000 investment and you borrowed that £5,000. You could offer your investor 12%, okay, APR. You could give 12% interest on that money. And do you know what? That would equate to £50 a month. And that would leave you with £950 cash flow. So your investor's getting a handsome return on their money and you're getting £950 profit from the deal. So how cool is that? So hopefully I'm reassuring people that you can still borrow money to invest in property. You don't have to own the property. All you need to do is represent a good rate of return for your investors. Now, what are you going to do with your 950? Well, do it again, do it again and start creating a job replacing income. Start saving up for deposits so you can start buying your own properties to do serviced accommodation with. But to start off with, let's create a win-win situation where you represent a good rate of return for your investors, and you could potentially do rent to serviced accommodation in order to do that whilst saving up for deposits to be buying properties as well. So what do you think? Let me know in the comments whether any of that makes sense. What do you think about buy-to-let? What do you think about HMO investing? What do you think about serviced accommodation? Now, do you know what? Some people are doing buy-to-let well, some people are doing it badly, some people are doing HMO well, some people are doing it badly, and some people are doing service accommodation well and badly. So quite often, you know, people will say to me, well, I'm not making that sort of cash flow from service accommodation. Well, sometimes there's a reason why. Maybe the person isn't doing it right. Maybe it isn't the right property. But the point is that you can definitely cash flow thousands of pounds per month per property from serviced accommodation if you're doing it right and it is the right property. So let me know what you think. Put your comments below and I will endeavour to answer you later on in the day. So here's to your success in serviced accommodation, and remember team, your future needs you. Take care.